urbanization of emerging countries is quite rapid, and that does create, from the perception of investors, quite a need and an opportunity for investment. However, cities, typically in emerging markets, are rather weak from a credit perspective, and often from a administrative capacity perspective. They are also very often supported by central government because they're not quite independent. Some of them are, but many of them are not able to procure, to develop their own strategies and projects without over support. For investors, it's very complex and fairly complicated to address a market when you don't have a public partner with a lot of strength across the table. And in addition, the issues that cities have to address in terms of meeting their sustainable goals are rather spread across various sizes of projects. Because you could be addressing healthcare in a city, you could be addressing mobility, and that sometimes is bigger size project, but you could also be addressing just making access to water or digital capacity into a city that has various sizes, complexities, different stakeholders to engage with within a city. So that is a very complex thing for an investor that wants to mobilize quite a lot of money. These particular initiatives that we have with the Rockefeller Foundation and the UNCDF is really trying to address all the obstacles that I mentioned earlier. The first one is preparation of projects. Cities do need help on the technical side, but also the financial side to prepare projects. So we have a catalytic capital facility that is funded by donors, and this is where we need that sort of public sector relationship and blending capacity. And on the other end, you need obviously project management and developing skills to help the cities develop those projects. And you need some funds, and this is where the equity part of the fund comes in place, which is a mix of DFIs, donors, and private investors coming all together to have an efficient and cost-effective facility to provide equity to those projects, to de-risk those projects, but also to de-risk it in a way that being an investor in those projects will give a signal to the rest of the market that the project has been properly prepared, that is investable. And so you could de-risk projects in many ways. It's not all about shifting the risk, it's also about creating a signaling effect for the rest of the market to be interested in the city's project. At the end of the day, no project can actually be developed if there is not a shareholder and an equity partner that is actually carrying it through. And it's and I know the tradition, especially for city, has always been to go for city borrowing and trying to execute this project. But that does mean that at the end of the day, the city keeps all the risk of the development and the success of the project or the usage. And this is where the equity part can come, and private and other public partners can come into place to support part of that risk and to take that risk and actually lead the development of the project. I mean, in Iridium, we use blending everywhere we can because we find that this public-private relationship can solve quite a number of issues. I mean, one of our very famous example was this Turkish hospital, Elazig, where we've used the strength of EBRD and MEGA to be able to raise bonds that are actually green bonds to develop these hospitals. So the equity was brought by Meridiam and its local partner, and the debt was actually enhanced and upgraded, if you want, with the EBRD facility and the cover from MIGA. And this is a bond which is still rated triple B in Turkey, which is no longer investment grade. Sometimes to make projects affordable, if I take the example of a biomass facility that we've developed in Côte d'Ivoire, concessional fund from the AFD group was the way that we've managed to make this project affordable, because the project's aim was obviously to produce electricity through biomass, but it also had another goal, which was to create incentive for small farmers to be able to provide their waste, because we're able to buy the waste from them, and that does create 1,000 jobs, small farmers. And so the outcome and the output in terms of social, employments, and environmental was major, but it was made possible just by a small concessional piece. The whole idea is trying to share it if it's not sustainable just by the city itself, with other mechanisms. So there are, especially in Africa, there's been a number of facilities that help, and of course, you know, they're coming from the DFI side of things to provide currency hedging. But again, these are rather onerous. And the pricing is quite high, so this may be an impediment on the country, on the projects of investability and bankability at the end of the day. We come from the philosophy that currency is actually a government risk, because it's about the economy of your government, it's about everything else. It's not intrinsically linked to the project. So as much as possible, trying to match currency between funding and uses, which is quite the first way to mitigate. You know, if you have local costs, have local revenues in front of it, but that's usually not sufficient. So you have to go further, and it's a bit of a tailor-made story for every single project. We've managed to put together a tool to be able to assess our contribution to SDG in all our investments. But of course, what we've done is to focus on 5 pillars. We can measure on the 17 NDGs, but we have decided to focus on what our strategy is. So we have a pillar around sustainable city and sustainable infrastructure, which is the 9 and 11. We have a pillar around access to to clean energy with SDG 7. We have a central pillar around climate, but SDG 13 was not good enough, so we've actually participated with the AFD group and a number of other people in Paris, or like La Banque Postale Asset Management and others, with this 2-degree challenge that allows us to measure the temperature of our portfolio. And we have 2 other pillars around equal opportunities, where we capture 3 SDG, and we also try to capture SDG 5, which is a very difficult impact to have within the framework of the UN, because it's very much policy focused rather than action focused. But that is not just monitoring. We also then create for every project leader or company project that we have has an action plan to improve, because you measure, but you also have to improve. So we set targets. We have 3-year target globally for Meridiam, but every project has an action plan to improve specific SDGs within, and that's included in our investment process, included in people's remuneration and objectives every year. So it's fully part of our investment process. It's not something that we add on or it's separate. It's totally integrated. I think the first thing is to have a clear set of priorities, because it's always very difficult for the public sector to sort out between priorities because you're trying to please every voter. A clear set of priorities and a clear set of ways to measure the impact of those policies. So if you decide that, mobility and giving access to clean and affordable mobility is your key priority, keep that as your priority, but don't try to do 5 different things at the same time. And I think investors like the sort of focus. It could be 1, 2, 3, but you can't have 10 priorities. So, we know that 10 priorities is no priorities. Then having clear goals in terms of what we're trying to achieve as an impact. And I think that's fundamental then to mobilize help to design and to prepare the projects. And obviously in a way that is palatable to investors. So it's transparency, clarity, and also the ability to mobilize, but investors can do that themselves. The community of the development community, if you want, around that.